The modern enterprise operates like a massive industrial engine, consuming raw materials, labor, and energy in a continuous flow to generate a final output. Standard financial accounting captures this activity, but only from a distance. It tracks the macro-level data, revenue in, expenses out, eventually producing aggregate profit and loss statements for external stakeholders. But a top-line aggregate number is often useless to the people actually running the floor. An income statement might show the company made money this quarter, but it cannot diagnose exactly where capital bleeds out on the assembly line. To manage millions of chaotic, daily transactions across dozens of departments, leadership needs a way to isolate the exact cost of producing a single unit. Optimizing the daily mechanics of a manufacturing operation requires more than just knowing total corporate profit. It requires visibility into the granular details of production. This is where cost accounting takes over. It is a highly specialized internal branch of accounting built explicitly for micro-analytical visibility. Raw financial data, materials, labor, and overhead enters a processing funnel. Cost accounting acts as a sorting mechanism, tagging and routing these chaotic inputs to specific operational nodes. Through this process, the system refines scattered data points into one precise metric: the per-unit cost. Management uses this exact metric to execute structural changes. When you know precisely what a unit costs to the cent, you can make targeted decisions on where to trim waste and improve efficiency. It functions as an informational architecture designed specifically to track and optimize how a company consumes its resources. Before building this architecture, we have to establish what the word cost actually means in an industrial context. The Institute of Cost and Management Accountants provides the definitive standard. It is the amount of expenditure incurred on a specific thing or activity. To measure that expenditure, the workflow begins with accumulation. This gathering phase pulls together scattered data, like raw material invoices, monthly utility bills, and hourly labor timesheets, into one central pool. As accounting theorist Walter W. Bigg outlined, this accumulation must follow strict, rules-based provisions. Grouping numbers arbitrarily won't work. The classification has to yield a highly accurate analysis of expenditure. A finalized cost is the result of a mathematically rigorous sum of every ounce of effort and material spent to produce an outcome. Once costs are accumulated in a central pool, they must be parsed using a blend of scientific principles and operational data. We visualize this sorting process on a classification matrix. Expenditures are separated on the vertical axis by nature, direct materials, labor, and overheads. Along the horizontal axis are cost centers, production, HR, and sales. During the allocation phase, categorized expenses lock into the exact center that incurred them. A steel invoice routes to direct materials and production. Conversely, indirect costs like an electricity bill are fragmented across production, HR, and sales. By charting every expense this way, management can pinpoint exactly which department is burning capital and on what specific resources. Strict classification and allocation protocols prevent valuable corporate resources from simply disappearing into a generic, untraceable expense void at the end of the quarter. Measuring this data is only the first step. The ultimate goal is to act using two distinct frameworks: cost control and cost reduction. On the left side of this chart, we have cost control, a reactive mechanism used to fix short-term operational variances. When the actual cost violently spikes above your budgeted standard, you have a variance problem. Management identifies why the spike occurred. Perhaps material prices jumped or labor became inefficient, and takes corrective action to bring the actual cost back down into alignment with the budget. On the right side, we see cost reduction. Instead of reacting to spikes, this process moves the entire standard line permanently downwards to a new, lower baseline. You achieve this lower baseline through advanced production technology, substitute materials, or design shifts. Crucially, this must be done without compromising the product's quality or its intended utility. Cost control forces the operation to obey the current standard. Cost reduction engineers a leaner standard. This granular data layer dictates how a company survives in the open market. Look at this basic pricing equation. Base unit cost plus target profit margin equals your selling price. If your accounting is flawed and base cost is inaccurate, the target profit margin becomes theoretical. the margin shrinks into the red, risking a loss on every sale. Conversely, having precise data isolates the exact profitability of individual processes, giving leadership the confidence to frame aggressive new pricing policies. Accurate cost accounting provides the only reliable baseline for setting a market price that ensures long-term profitability. Maintaining this internal architecture is not always a voluntary strategic choice. In many jurisdictions, it is a strict statutory requirement. Take Section 148 of the Companies Act in India as a primary example. Under this law, companies engaged in specific manufacturing sectors or those exceeding a 35 crore overall turnover are required to maintain rigorous cost records. If a company meets these criteria and fails to pass statutory cost audits, they face severe legal penalties and fines. Cost accounting acts as the sensory nervous system of an enterprise. It measures operational efficiency, prices products competitively, and ensures legal survival.